I've had a few private messages lately asking me why I haven't made a video in a few weeks. The perception is that so much has been happening lately, and things are moving very quickly. So why not comment on it? I agree that there is much that some have reported on and commented on lately, but for the average accumulator of wealth, most of it is simply noise and should be ignored. When viewing money, debt, and the economy, we are better served watching for long-term movements. These trends move more like cruise ships than fast-moving jet skis. The reason why we hear so much exaggerated commentary is that the people have newsletters and products to sell. If they don't have something new to say frequently, then they will lose their subscriber base. Unfortunately, if you act upon their recommendations, you are just as likely to lose some of your hard-earned wealth. I'll talk a little bit more today about interest rates. Everyone is talking about the impending, sudden, and large interest rate increase that's imminent. I've said before that interest rates are unlikely to increase until economic activity increases, creating a demand for new debt. Let's look at some trends and see if we can ignore the jet skis and see what the cruise ships are doing. Notice that for the past 35 years, rates in the US have been falling. Sure, there have been some up and down movements, but the long-term trend is clear. Rates have been falling slowly and steadily. Sure, it looks like long-term rates have leveled out around 2% and have stopped falling, but there is no sign of an immediate increase. And we're not the only place where rates have been falling. Here I've overlaid Japanese 10-year rates. Notice rates in Japan have fallen relentlessly too. The trip down for Japan was a little bit more volatile, but their credit market has pretty much fallen in lockstep with ours. I could overlay the interest rates of other Western economies on this graph, and it would show the same trend. Interest rates have simply fallen long-term to very low levels. Does this mean that rates are due to rise? After all, they shouldn't be able to go much lower. The answer is that if rates make a big move, they are more likely to go up than down. But such a move is not necessarily going to be quick or sudden. Let's look back at our own history and see if we can find some clues from our past to see what might be in store for our credit markets. Here is a 30-year trend of US 10-year interest rates starting from the year 1920. Notice we had a very similar trend. Interest rates fell long-term over 30 years. Though it should be noted that this multi-decade trend started from a much lower starting level of interest rates, probably because at the time gold was still officially tied to our money. Study this curve carefully and compare it to the trend I showed to the US interest rates from 1980 through 2015, and you'll see that they're very similar. The trend is quite jagged, but it moves relentlessly lower. The reason was not government manipulation. It was a gradual slowing in the rate of demand for debt. What happened to rates after the bottom was reached at about 2% in 1950? Let's take a look. We can see that interest rates did climb, but the climb was not swift, large, or sudden. It took a full decade for rates to climb back to where they had started in 1920. Did long-dated bonds lose some of their value as rates rose over this decade? Yes, they did. But the decline in value was not nearly as large as many are suggesting will happen to bond investors over the coming few years. And I'm not saying this because I'm a big fan of paper investments. I'm not. I'm simply saying that when people are saying that bond investors are going to be massacred from here because bond rates are so low, they're simply not taking history into account. If one carefully studies history, one will find that the bond buyer in 1950 who bought a 10-year note and held to maturity actually did better than the person who continuously rolled over low-yielding treasury bills or bank CDs out of fear that rising rates would destroy the value of their bonds. Again, I'm not proposing anything here. I'm not saying that you should invest in paper. I'm simply saying that those who are calling for bond market massacre might not turn out to be right. But what about all of the extraordinary spending and monetary measures taken by the government over the past 7 years? Surely what is happening today is different than what happened in the 20th century, right? let's check that assumption. In 1933, Franklin Roosevelt devalued gold by declaring the dollar to be worth only 1/35th of an ounce of gold, when prior to that year the dollar had been valued at 1/20th of an ounce of gold. This was a quick and sudden 75% devaluation in the dollar. Did this cause the economy to suddenly improve or interest rates to reverse their decline? The answer is no. Interest rates continued to fall and the economy continued getting worse. Roosevelt's actions simply prevented the banking system from completely failing. It's very similar in function, though not in form, to the measures taken by the U.S. from 2009 to 2014 when base money expanded by a few orders of magnitude. It prevented the banking system from failing, but did nothing to revive the economy. The massive spending related to World War II that many attributed to ending the Depression also did not suddenly revive the economy, nor did it cause interest rates to rise suddenly. So we can see that monetary debasement and massive government spending does not create the kind of economic pull and demand for credit creation that can cause an increase in interest rates. So what did? Let's take a look at debt levels relative to GDP. Notice that at the end of World War II, government debt levels rose to 120% of GDP. The government borrowed a lot of money, and I mean a lot. The Keynesian actions intended to end the Depression probably made things a lot worse. Fortunately, when the troops came home from the war, they started working, having families, and creating households. This created a boom in the economy. Economic activity picked up big time, and by the year 1960, debt levels relative to economic activity were almost back down to pre-war levels. And it wasn't the debt levels that fell, it was the economic activity that rose. And the important thing to notice is that the interest rate rose as economic activity increased. There was a demand for private sector borrowing, and this demand increased interest rates as the economy grew. Zooming out a little, we can see that the trend continued until the year 1980. The economy kept expanding, debt levels relative to the economic activity continued to fall, and economic activity itself, and the demand that it created for credit, caused interest rates to keep rising. Now again, I'm not saying that debt fell. Debt did not fall. Debt continued to increase during this period of time. It was the economic activity that increased faster than debt levels increased that caused interest rates to keep rising due to demand for credit. Zoom out further, and we can see the correlation even better. After we passed the year 1980, our debt levels started to grow faster than the economy grew. Debt grew relentlessly over the subsequent 35 years. Contrary to what most theories might state, this did not cause interest rates to climb. Quite the opposite. Interest rates declined as debt levels increased simply because the growth rate in real economic activity did not keep up with the debt. And this gradually reduced the relative demand for credit relative to the economic activity. Less demand for credit means lower interest rates. Hence, interest rates fell. So now I ask you this question. If it's an expanding economy that creates demand for credit, and it's the demand for credit that causes interest rates to rise, what is it exactly that's going to cause a sudden large interest rate increase in the near-term future? What is it that's going to create large losses for bond investors? Is it going to be demographically driven growth like we saw in the mid-20th century? Not likely. We have an aging population in the West and fewer new workers to replace the retiring workers. Is it going to be formation of new households? Not likely. Generation Y and the millennials are reportedly choosing to rent and are not really getting married and having kids like they would be expected to. Is it going to be a surge of buying by those who are graduating from college? Not likely. Those who are graduating from college now are already mired in debt and aren't able to find jobs. No, I see two possibilities from here. The first possibility is that we just muddle along over a very painful couple of decades until debt levels can be worked off to healthier levels. In this scenario, demand for new debt will continue to be low, and commodity prices will continue to be weak. If this scenario unfolds, long-term bonds will perform well, and the stock and commodity markets will be very unfortunate places to be. The other possible scenario is the reset scenario that I've talked about before. In this scenario, the entire financial system breaks suddenly because the burden of debt makes it simply unpayable, and all confidence is lost quickly. In this scenario, the only things that are likely to work well for the gradual accumulator of wealth are personal property that can be put to personal use and gold. If all else fails, a paid-off house with some land and some gold will be the only truly safe possessions. Now, I see both of these scenarios as real possibilities, and I can't say for sure which one will unfold. One thing I do know is that for us to find out, it's likely to take a while. So ignore all the noise. The news you really need to pay attention to will not be delivered to you on a daily basis. Just keep your eye on the big picture and use all of the time that this will liberate in your life to do things that will enrich your experience during this short time that we have to spend on this planet.